One single candle is all you need. You do not need a different strategy or more trades. You just need better ones that all look the same. This one candle tells you when to enter and how to avoid losses. You are either engaging in this portion of a bullish candle or you are engaging with this portion of a bearish candle. And before I get into some charts on exactly how to predict the next candle, yes, this works on every single market. You can use it on futures markets or forex markets. You are either trying to predict the weekly, the daily, or the 4-hour candle, depending on what sort of trader you are. I say all the time that personality matters in trading. For example, me, I am someone who likes to go and do my own thing. I have other hobbies. I create content for you guys. So I like to engage with daily or weekly candles. If you are someone who has the time to be on the charts, you can trade the next 4-hour candle. So how exactly do we go about doing this? Well, first of all, you have to mark out a range. A range is defined by the clearest price swing on your screen. If you are not sure, guess what? You are probably too far zoomed out. You want to zoom in. This strategy alone, predicting the very next candle and nothing else, has gotten me max allocation with FTMO, over 6 figures in payouts, and it's all over my Twitter, Telegram, all of that. I've shown it before over and over again, but what we are looking for is a range. Now, high probability happens when one side of this range is taken out. So you are working between this low down here and this high. Why? Because we are zoomed in and this is the most obvious price swing on your screen. You only need to predict the next candle. So at this point here, when we take out the previous candle's high above this range high, look how this daily candle on Tuesday the 31st of March closes. It rejects the candle's high and closes back inside the previous candle. And then look what happens next. This candle opens, trades higher, and then closes back down below this first candle's low. So all you need to trade is a 3-candle pattern. Now the 3-candle pattern, we do not trade that alone. We don't trade that alone. We trade that within context of a wider marketplace. And what you must understand is then it only works. Now the thing I want to teach today is this 3 or 4 candle pattern, because this can get down to the 4th candle depending on order flow, is a market maker sell model. If we drop time frame to the 15-minute time frame, is this not a typical market maker sell model, with the draw on liquidity being an original consolidation? A market maker sell model forms in swing points. Please listen to what I just said and repeat it to yourself. Write it down. A market maker model forms in swing points. So how do we engage with this next candle once it's predictable? Let's go back and say why it's predictable. Where we took out this external range high back here. And then this candle, which started at this point here, closed back inside the previous candle's range. So this delineation here on my screen, these lines, this is the first candle. This is the second candle. And beyond this line is the 3rd candle. The first candle trades higher into a key level. So this high back here is not a random high. It is previous day high, or if you are fractalizing the concept, previous candle high. So you need a previous candle high taken, and you need this candle to close back inside the first candle. That's exactly what we have here. But we're not trading this randomly, because what you are looking for on this time frame is displacement and a key level. So if we go to the 1-hour chart now, you can use the 15 and the 1-hour chart for this. Remember, this is candle 1, and coincidentally, randomly I'm sure, you have an original consolidation down here. You then have candle 1, candle 2 taking out candle 1's high and closing back inside. Why does it have to close back inside? Because everything we do is built on logic. It is not random. So we need confirmation. Confirmation comes in the form of displacement. Now, what is displacement measured by? I've said it before. I said it in my free course over and over again. It is speed and distance. Distance will create fair value gaps, as will speed. Then you are just looking for a key level. Now, do you see a clean 1-hour key level inside of here? Inside of this line forward? Because this is the 3rd candle in our 3-candle pattern. I do not. So you can even go to the other time frame and take a look right there. What do you have at this point? An up close candle, which is blatantly obvious. That is an obvious up close candle right there. Again, candle 1, candle 2, candle 3. Candle 3 trades into our up close candle and then drops off a cliff. So how do we get involved with this market? You fractalize the concept. It's the same thing over and over again. Look where we are heading to, a discount of this dealing range. A discount. You are in a premium, you tag the order block here, and then we're targeting this original consolidation and or a key level below it. Then you fractalize it. So at this point here, we hit the 4-hour key level. Everything is choppy up to this point. Nothing is clear. I wouldn't enter a market like that. I just wouldn't. My one-to-one students know it. All of you guys who watch this channel probably know it. I would not trade a market that looks like that. But look what happens when we form the 4-hour key level. It becomes blatantly obvious. We trade above this buy-side liquidity into the orange line, which is your 4-hour key level. If you drop to the 5-minute chart, you then have displacement through there. Look at that displacement. And what do we close below? A bullish fair value gap. So I am making trading easy for you. I promise you, if you have the patience to wait for this to appear in the correct market cycles. What do I mean by that? Distribution, a market that is ready to move somewhere. And we'll go over again why this market is ready to move. But this fair value gap here, why is this your confirmation when we close below it? Because in a bullish market, you would expect this fair value gap to go higher, but we're not in a bullish market. We have a bearish bias established by the narrative that I outlined in the beginning of this video. We then close below that 5-minute gap. So there is your entry on the retest of that 5-minute gap right there-ish. And then stop goes above this rebalanced area. You can target a 1 to 2 or a 1 to 3. The point being, you do not need more trades. Like I've said a million times over, you just need the patience to wait for a daily chart to look like that. We take out equal highs back here, relatively equal highs, and then this candle closes back inside Monday's candle. So is Wednesday's candle not predictably bearish? Do I care that we've been bullish, really bullish up to this point? No, because I'm only trying to predict the next candle, and you should be too. There is nothing more you need than this. If you can predict the next candle, you have a trade. The exact same thing happened down here. Take a look at this. We take out previous week low and notice what DXY did at this point. It was trading much higher. So we have an SMT between USD CAD and DXY right there on these weekly candle lows. So the next weekly candle is predictable. We trade lower and then trade higher to previous week high. And then look what happens. We trade lower, we trade higher. Why is it still predictably bullish? Because we traded down into a key level, equal lows. We traded down into that key level and then printed an up close candle that closed above the 2 down close candles here. So this candle is bullish. There's a small scalp in there. So is this one. And so is this one. But then we hit external range liquidity here, because this external range liquidity broke this swing low down here. So when a low gets broken, what do retail do? Below this low, what do retail do? They sell the market. So where do we target? The high that they would put their stop loss above. People who sold short down here when we broke out of this market, their stop loss goes where? At resistance. So we target that resistance on the buy side liquidity. And when we take it out, they get punished once more, because what do retail do above this high? The exact same thing they did down here below this low. They buy this market and then they get punished. And that is why this market works. That is why this strategy works. It is so important you watch this video over and over again. If you did find it valuable, drop a like and drop a comment. Subscribe if you are new. If you want my full 5-hour course, it is the top link in the description. Thank you as always for watching, and I'll speak to you guys later.